we seeing more stress in the credit markets, and why are we seeing records on Wall Street? And like, it sounds like then some disconnect.
I think part of the reason that the street has been doing well, listed stocks, is because you have a lot of liquidity coming out of private markets, going back into more liquid markets. Makes sense, right? Private equity, private credit is a mess. And we all know this. Something like 15% of private equity companies in the U.S. are paying in kind rather than in cash.
Right.
So you know
we keep waiting for the year to like the exits and for things to move on.
There's a lack of demand from banks for loans, except in one category, non-depository financial companies, which is another way of saying private equity funds, credit shops like Canaries and Apollo. They're the ones that have been aggressively expanding their business, using money in part from banks. So the banks are now the facilitators. And what does this remind us of, Carol? The 2000s.
Right. Right.
It's the same thing. You have non-bank intermediation relying on the bond market, equity markets, and bank credit. And the thing is, eventually they're going to stumble. And that's what everybody's worried about, I think.
So what does that stumble look like? What is the shoe that drops?
It looks like First Brands. Hello, we're defaulting. And most people had never focused on that company. It was a private, totally institutional play. The same thing with Tricolor. Auto lender that, you know, half of their customers were illegal aliens. Nobody had ever focused on this. It was an institutional story that suddenly surged.
So you think
those
two instances are canaries in the coal mine?
I think they are typical of what we're going to see more in the future, which is you're going to see more of the missteps in the institutional non-public market, which was supposedly better. Remember, everybody was selling us the idea that private was better than public? No, we have public markets because they're open and relatively liquid.
Chris, you know, after the Jamie Dimon cockroach comment, that there were many members in the private world that came out, or a few, I should say, that came on our air, and that seemed to say, hey, listen, things are fine. And I understand many would say they're talking their book, but, you know, are they systemic risks? Like, what's the exposure with the traditional financial sector when it comes to the private markets? Because I think that's what we care most about, right?
No, I think the private players can fail tomorrow. It will cause a bit of kerfluffle and volatility in the markets, but are they systemic like a big bank? No, but the big banks will take their lumps too, because they are lending indirectly into these structures. They tend to take the most senior positions, but that may not save them. You see, the assumption that, okay, I'm senior and 3/4 of the stack is below me, and therefore I'm okay, that may not work this time around because you have leverage on leverage on leverage in some of these deals.
So when like the big banks report again, we're getting ready for another earnings cycle, right? You know, we'll get that, you know, in early January. So what do we look for things like that? Like, what do you look for?
The numbers are going to be wonderful. That's what worries me. You know, just as an analyst, we were supposed to have a recession last year. Credit losses largely peaked last year, third, fourth quarter.
Yeah.
They've been coming down since then. So if you look at the picture, you say, God, everything is great. You don't see a lot of utilization. You don't see a lot of demand from the banks for credit. They've got a ton of unused credit out there that they wish people would use. But so you don't see stress in the published numbers. Where you see stress is when you talk to professionals, when you read the really interesting media like Bloomberg and others that cover some of these stories. There was a great piece in the FT over the last week talking about Altus, a company that Jamie Dimon came to the rescue of, paid off their most restrictive loans so that they could go out and borrow more money.
So like,
and all the credit guys that you're talking about looked at Jamie Dimon and they're going, hello, what are you doing?
Yeah.
So he's an enabler of bad behavior because Jamie has to go out and make money too in a market where there isn't a lot of, you know, what I would call quality demand.
Which reminds me of what would happen in the great financial crisis, of people saying, I know it's getting messy and ugly, but there was the CEO of Citi at the time, I think, who like came out and made some comment about, like, I got to be in it. Like,
oh, no, that's right. Yeah, that was the
I can't think of
the temporary CEO who you know, replaced John Reed.
But I'm just saying, like, this idea of like feeling like you have to be in it, the pressure of it.
Yes and no. I think that some institutions have the common sense to pull back and say no.
Yeah.
Others don't. I'll give you an example. PNC. PNC has the lowest loss rate in the top 7 banks. They've also got one of the lowest funding costs. That's a fairly well-run $500 billion bank that has managed to avoid risk, I think often by saying no. The street wanted them to get more involved in certain things like prime brokerage, dealing with private equity funds, that sort of thing.
Right.
And they said no. So I think there are institutions that are very well run in this market. But again, the banks are underutilized because the non-bank financial companies have stolen their march, and they're going to the customer, and they're using wholesale funding from the big banks, and they're in turn disintermediating them at the same time.